Hello and welcome in the thick of earnings. You're watching NDTV Profit. I'm Harsh Saita. We have with us the Managing Director and CEO at Bank of India, Mr. Rajneesh Karnatak, to talk to us about Q1 numbers, I beg your pardon, for FY25. Sir, first off, welcome. Good morning. Want to try and understand what's happening with margins because they've gone up. Any one-offs here? Also, if you can tell us whether this level of margin number is sustainable going forward through FY25 given the deposit growth pressure that's there in the system.
Yeah, so margins have improved for the bank. If you see the NIM, it has been closed at 3.07 and it has been increasing sequentially and on a YOY basis. So if you see March 24 for Bank of India, our margin was at around, NIM was at around 2.92 and in June 23 we were at around 3.03. So margins is improving and it is improving because our yield on advances has now touched 8.60% and we have grown the yield on advances by 50 basis points on a YOY basis. Cost of deposit is also 4.82% and that cost of deposit has increased by only 60 basis points and the gap between the two is around 3.6 basis points. Because of which the NIM is around 3.7%, 07%. But definitely this NIM is also improved because of some recoveries happening in the return of accounts where the same is going to the non-interest income. That is one of the reasons. So considering the fact that there is pressure on the resources and the interest rates are rising in the deposit side, domestic deposit side, and CASA and retail term deposit is a challenge, we feel that margins will be under pressure. But still we will like to maintain our margins at shade below 3% for the current financial year.
Understood. So margins likely to cool off for over the next 2 to 3 quarters is the sense I'm getting from you. Your yields have gone up, you suggested. Talk to us about what has changed in terms of the book. Is there a change in book composition? Is there a change in focus with regard to what areas you are growing in? Is this a conscious effort or is this something that's just happened in a one-off quarter?
No, it's not a one-off situation which is there. It is a conscious call at the top management level that top line is important for us, but equally important is the bottom line. So if I tell you that the last time the Reserve Bank had raised the repo rate was in January 2023 from 6.25 to 6.50%. Since February 23 till date, as we speak, we have raised our MCLR by 6 to 7 times and presently the MCLR has gone up from 8.4% to presently 8.95% on a 1-year MCLR. So we have increased by nearly 55 basis points. So transmission to the lending side has happened from our bank side. Another thing that we have done is in the corporate book, we are not lending at repo rate or any advance which is up to 180 days. So anything which is above 180 days, we are lending on the MCLR side and our MCLR, the lowest MCLR is the overnight MCLR, which is 8.15%. So we are very conscious of the margins that we are trying to maintain and there is no particular shift in the overall credit number in the sense that 55% of our book will be continue to be the RAM book and 45% will be the corporate book. Within that, MSME, retail and agriculture is there and the other portion is there as regards the interest rate composition in the book, credit book, standard book which is there. Fixed book is only 6%, remaining 94 is floating which is linked to the deposit market rate. So we are very conscious on the margins which is there per se and the NIMs we will try to protect as much as possible in spite of the pressure which is there.
Understood. So incrementally you're not doing riskier product to push yields. That's what I was trying to gauge. Are you pushing yields through riskier product?
No, we are trying to keep a balance on the credit growth side after due diligence and other things. So if you see our corporate book also where 80% plus is on the investment side, the external benchmark rate, external rating advances. So there we are trying to grow our credit book with BBB advances also, A advances also, where margins are better on the interest rate side and non-interest income, process fee and other LCBG commission is also better. So in a very nuanced approach, we are trying to grow our corporate book also and also our RAM book.
Understood. And advances growth as well as deposits growth quite strong for you when I'm looking at it sequentially. Talk to us about what's driving the kind of growth that you're seeing because not too many banks showing at least growth on the deposit side which you've shown this time.
So deposit has always been a very strong franchise for Bank of India. So if you see our slides which are also there, only 14% of our total domestic deposit is bulk deposit. Remaining 86% of our deposit is either CASA deposit or retail term deposit. In fact, we have closed our CASA number at around 43% of the CASA book. That is there. And 60% of our branches are in rural and semi-urban areas, which are giving us good CASA numbers and the retail term deposit. So as far as our bank is concerned, there is no much challenge as far as the increase in deposit is concerned. If you see sequentially also from our slide, we have grown our deposit more than the advances on a sequential basis from March 24 to June 24. But on a year-on-year basis, right, our credit has grown more than the deposit. But sequentially, since we have given more concentration on raising deposit in the Q1 quarter of this financial year, our deposit growth was more than the advances growth in Q1 quarter.
Understood. And I want to try and tie this in with what's happening on the provisioning as well as credit cost front. So while growth has been likely quite a strong driver in that sense, margins have also gone up, but what's happening on credit costs? Where should they lie on a normalized basis, because they've come off quite sharply, and tell us just what's happening there and what can the full year FY25 guidance be?
So on the credit cost side, if you see our credit cost, we closed at 0.85%.
Yes.
Sequentially, it is improving. If you see the credit cost, which was there in March 24, it was 1.4%, around 1.4%. So provisions we have made in this quarter as a matter of prudence. In fact, if you see that our provision coverage ratio has now improved to 92%, our gross and net NPAs have also come down sequentially. Gross NPA, which was earlier much above 5%, now it is 4.62. We were already below 5% as on March 24. It has come down further to 4.62. Net NPA, we have for the first time gone below 1%, and we are at 0.99%. So that is another number which is there. So provisions definitely in this quarter credit cost was high, but overall in the entire year, I think the credit cost would be at around 0.70% on an annualized basis, because most of the provision which was there has been made, and good recoveries are also happening. If I tell you on the recovery side also, we have fresh slippage of only 1,900 crore. Against that, we have done a total recovery of 2,700 crore, which does not include the write-off. So this recovery is from upgradation through cash recovery and recovery from return of accounts or in the interest income in the NPA account. So 2,700. And if I include the write-offs also, then the total reduction in the NPA book is around 4,000 crore in this quarter itself, as against fresh slippage of 1,900 crore. And our cash recovery to slippage ratio within that is already 1.4042%, which is excluding the return off. So already we are at a healthy number, which means that against 100 crore of slippage, we are doing a recovery, cash recovery, upgradation, and recovery from the return of accounts of 142 crores. So that is the kind of runway we have built now from this quarter.
But so I noticed that metric and it was very impressive. I agree with you, Mr. Karnatak. But is that sustainable is what I want to ask. And also, what's the full year FY25 guidance on recoveries?
So this number will be sustainable for the reason that we have a lot of put effort. Our ARB branches and our recovery setup has been tightened. The entire organizational setup has been revamped. So we have a lot of OTS schemes also, which the fields are doing, not only from the normal OTS, which are there for small accounts, mid-corporate account and large accounts, but even for the return of accounts, targets have been given to the field. In fact, internally, we have given a target that our total recovery should be twice the number of slippage which is there. So overall, the end of the year, you will see a better number as far as the slippage ratio is concerned. Present slippage ratio is already down at 0.35%. So we, on the annualized basis, if I can say that, we will be trying to maintain our slippage ratio at around 1.10%.
Understood. Sir, what's your full year loan growth as well as deposit growth guidance, if I may ask?
So as far as the credit growth is concerned, on the global credit growth side, we will be growing at around 13 to 14%. And on the deposit side, global deposit side, we would be growing at around 10 to 11%.